Did you know CPAs work around the clock on taxes, audits? Yes, it's quite a shock. But business owners, they've got a dream. More tax saving strategies, that's what they need. Welcome to Proactive Tax Strategies. And we're here to take away your high tax fears. We got secrets, magic in our hands. Tune in as we travel.
Welcome, everyone, to another exciting episode of Proactive Tax Strategies. I'm Patrice Sikora. Now, today we have an amazing topic lined up for you: premium finance life insurance for wealth growth. Our host, Ken New, owner of Pinnacle Financial Wealth Management and team-based model consultant, enjoys diving deep into the world of tax strategies. And today we have a special guest with us, Darren Sugiyama, founder of Lionsmark Capital. Mr. Sugiyama started his own employee benefits firm in 2003 called Apex, and later founded Lionsmark Capital in 2016, and it is now one of the most dominant premium financing intermediary firms in the life insurance industry. Darren is also an internationally acclaimed 11-time author, business coach, and mentor. Without further ado, Ken, just let me hand it over to you to kick things off and take it away.
Yeah, thank you, Patrice. Welcome, everyone, and welcome to Proactive Tax Strategies. I'm your host, Ken New. So today we're going to dive into an intriguing subject, premium financing, and the role that it plays in tax strategies. So joining us is one of our virtual family office experts and an expert in the field, Darren Sugiyama. Darren, welcome to the show.
Yeah, thanks for having me.
Yeah, terrific. So let's get right to it here. What exactly do you do? And, I know that everyone knows life insurance has premiums and advanced strategies can have rather large premiums. So what exactly is it that you do? And talk to us about premium financing, because that's kind of that area of expertise for you.
Sure. So I'm what they call a premium financing intermediary. And what that means is I work with investment advisors, life insurance agents, CPAs, estate planning attorneys all over the country. And they bring their clients to me to do pretty much one thing and one thing only. And that is to design the most prudent way to fund an extremely large life insurance policy. These policies on the low end can be as low as $10 million, as high as pushing $100 million. So this is really kind of a wealthy clients type of strategy that they'll use typically to fund the estate tax liability that the next generation is going to incur when they inherit their parents' wealth, their overall estate. So oftentimes life insurance is a great way to fund that liquidity event that's going to happen in the future with their impending death. Where premium financing comes in is the concept is not all that different than, say, purchasing real estate using a mortgage loan, right? You're using a third-party bank's or lender's capital to fund this asset, largely because the client wants their liquid capital working elsewhere. Maybe it's in their business, or maybe it's in some sort of alternative investment. So oftentimes it's just a more efficient way for a wealthy individual to purchase a very large life insurance policy.
Yeah. So who exactly would this be appropriate for? I mean, when we talk about wealthy people, 10 million to 100 million, that's a pretty big spread there. Who's the typical client and what's the circumstance that would be appropriate for them? And maybe even who it's not for, to reemphasize that.
Sure. Oftentimes when people ask me what exactly I do for a living, starting off with talking about life insurance is an easy way to bore them to death. So, and that's really kind of shortchanging what it is that this type of strategy actually does for a wealthy family. So I'll give you an example. Let's say you have a family's net worth is a little over $100 million. Under current tax law, they're able to pass a certain amount on to generation 2 untaxed, but every dollar above that threshold is taxed at a rate of 40%. The challenge that a lot of these wealthy families have is that on $100+ million net worth, Oftentimes, a lot of that estate's value is in real estate. It is largely in the valuation of the family business. So these are two very illiquid assets. What happens upon death of both the patriarch and the matriarch of the family is that when generation two inherits that estate, they have 9 months to pay that 40% tax bill. So you're talking about roughly $40 million. The challenge is that a $100 million estate oftentimes does not have $40 million in liquid cash to pay the IRS. Oftentimes what will happen is the inheriting children, adult children, will fight each other to the death over which assets to sell. So as an example, let's say you have the firstborn son, and he's running the family business. He's been working side by side with his father from the very beginning. The family business is essentially his baby. He certainly doesn't want to sell shares of the family business, right? That's kind of his baby. And let's say his younger sister, who is smarter and more talented than him, got passed up by their father to run the business. So his sister hates the family business. She despises the family business. So she could care less about that. She would love to sell the family business, but perhaps she has a strong emotional attachment to the family vacation home in the Hamptons because that's where they spent their summers growing up. She doesn't want to sell the family vacation house. And then let's say she has a younger brother living in Miami. He's single and ready to mingle. He's living in the penthouse paid for by his parents. He's hanging out on the gazillion-foot yacht with a dozen supermodels, living the single life. Well, he doesn't want to give up all the toys that come with his single life. So you have two brothers and one sister that are going to fight each other to the death practically over which assets to sell to pay this $40 million tax bill. It can really, I mean, the financial side of it is devastating enough, but what's really devastating is the disintegration of the relationships between those siblings. These are rich people problems, obviously, or uber wealthy people problems, but problems nonetheless. What life insurance can oftentimes do is provide that liquidity to pay that impending IRS tax bill. So a family like that may opt to purchase a $40 million life insurance policy on the patriarch and the matriarch of the family so that when the last spouse dies, that $40 million death benefit pays out to the trust, and then the trust can pay the 40% in estate taxes due. So though I say I'm in the premium finance life insurance business, what I'm really in is the family relationship preservation business.
Yeah, with that example, it definitely sounds like there would be drama playing out if planning wasn't in place. Almost sounds like watching a soap opera on TV or something like that. So they obviously need premium financing, or it obviously is something that they should take a strong look at. Could that dial down to someone who might be worth 10 million, 15 million, 20, 30 million?
Yeah, great question. So historically, premium financing has really been kind of reserved for the decamillionaire population and up. About 7 years ago, I went around to several of the insurance carriers and I said, with this wealth preservation strategy really should be offered to a wider population, because though you may have to chop off a zero or two at the end of the number, the issues are the same, right? So let's take a couple in their 40s. Let's say the combined household income is a little over $500,000. Let's say their net worth is quote unquote only 2.5 million, 5 million, something like that. In the life insurance world, I was told that people with net worths under the $10 million threshold were not sophisticated enough to understand or employ this type of premium finance strategy. And I said, that is the most ridiculous thing I've ever heard, because how many of these folks own homes? Of the folks that own homes, how many of them purchase those homes using a mortgage loan? So they understand debt as an instrument, as a financial instrument already. It's just a more efficient way to purchase a valuable asset. Same thing with the purchase of automobiles, right? How many people finance the purchase of automobiles? How many people have financed their college education? How many people have financed business expansion using a business line of credit or an SBA loan? So most of these folks that have relatively substantial incomes, multi six figures and up, have a similar need in the effect that if the breadwinner passes away and the surviving spouse doesn't have the ability to replace that amount of income, the bills don't change, right? The overhead doesn't change. And so families like that oftentimes need life insurance in the short term to cover the lost income that would occur if the breadwinner was to die prematurely, car accident, cancer, heart attack, something unexpectedly early. However, once those folks get to retirement age and the kids are full grown, perhaps the mortgage is paid off, perhaps they do not need as much life insurance death benefit. But if you use a particular type of life insurance product, it accumulates what they call cash value. Think of it almost kind of sort of like an investment account embedded inside the life insurance policy. Depending on the type of life insurance policy, that account could grow based on the dividend performance of the insurance carrier, or it could be correlated with some sort of index, like the S&P 500 as an example. The nice thing about this, because it's housed inside the life insurance policy, due to IRS tax code section 7702, the accumulation of those funds grow tax-free. And then during retirement years, the client could start to draw down retirement income from that life insurance policy on a tax-free basis as well. So it kind of kills two birds with one stone, right? It protects the loss of income in the event of a premature death of the breadwinner, and then also it can serve as a tax-free retirement instrument.
Yeah, that's great. So I've heard then two basic uses of premium financing at a high level, and this is advanced work, of course, but liquidity for those uber wealthy in the scenario that you talked about with passing the assets on to siblings, and then loss of income for high wage earners. And then at the same time, it could extrapolate itself out to provide a tax-free retirement income. Does that
Yes,
sound about right?
absolutely.
So who would it not be for? Who's someone out there who might say, hey, this is exciting, I'm going to make this happen, and it's just not appropriate for them?
Yeah, so a life insurance policy, again, depending on the type of life insurance policy you use in this type of strategy, some are more flexible than others. Some you can condense the number of years of premium that would be contributed. Some of them you can extend it. Where the what we call unsuitability comes in is when you have a client that is committing to a certain dollar contribution annually, let's say for 10 years as an example. And the question becomes, what happens if that client's income, their personal earned income, takes a drastic nosedive? If they are a highly compensated executive, if they get laid off and they go unemployed for a couple of years, or if they are a small business owner, entrepreneur, and their business takes a hit, financially, for a few years, what happens to that life insurance policy if it is not funded with the amount of premium that it should be funded with? That can become a problem. There are several flexibility variables that you can take advantage of. However, for someone that doesn't have a lot of liquid net wealth, right? If they have a high income, but they are not very liquid, in the event that their income dries up and they don't have any liquid to fund it, all of a sudden they need to start pulling these various levers, which really completely derails the original design of using this life insurance policy for its intended use. So that's why typically we want to see the client have enough liquid sitting on the sidelines so that in the event that their earned income gets decreased substantially, they have the funds to continue to fund the strategy the way that it was originally designed to be funded. So I'll give you an example here. If you have a young cardiologist, making $500,000-$600,000 a year, that type of client from an income sustainability standpoint is very different than, say, a small business owner that makes widgets, that's making the same $500,000 to $600,000 in annual income. And the reason I say that is because even in times of recession, typically cardiologists are not out in front of their clinic with a cup in their hand, going broke because of the recession, right? It's almost kind of a recession-proof type of profession. Whereas, say, a small business owner that's making widgets, if regulatory laws change, if the economy changes, if anything in their industry changes, that small business owner could be out of business within a year, and may have a very difficult time recovering and rebuilding their company, or starting a new venture and getting their profitability up to where their cash flow can continue to fund this type of life insurance strategy. We always want to look at what are the specifics of the client's profession / business. What type of income do they have? How sustainable is that income? How much liquidity they have? Those are all things we want to make sure that we are installing this type of strategy with the right type of client for the right reasons at the right time.
Yeah. Yeah. So it sounds like if we get the suitability right, and it's correct for the client and accomplishing the thing that they're trying to accomplish, then the next X factor is, with this word financing comes interest rate. And so interest rates today are a little bit different than they have been in the past. And, they're unknown, but they're slightly elevated at this point in time. So how does that affect premium financing for those that it is suitable for?
Yeah, no, great point. Over the last just few years here, we've seen a huge increase in borrowing interest rates right across the board, not just the premium financing, but with mortgage loans, with car loans. I mean, you name it. Just to give you an example of the increases in borrowing interest rates, if you look at 30-day average SOFR on January 3rd, 2022, this average SOFR rate was 5 basis points, meaning 5% of 1%, right? Practically nothing. Fast forward a year later in 2023, January 3rd, 2023, that rate went from 5 basis points up to 4.12%. And then towards the end of last year, on November 3rd, 2023, the SOFR rate was 5.32%. So we went from virtually zero up to 4% to almost 5.5% within a very short amount of time. I would say the same thing about the Treasury rate. The 1-year CMT rate at the beginning of 2002 was 38 basis points, so 0.38%. 1 year later, it jumped up to 4.72%. And then by the end of last year, it was up to 5.37% in November. So it's a huge, huge increase. And I don't think anybody, regardless of how smart they pretend to be, I don't think anyone projected the rates would go up that much in that short amount of time.
Mm-hmm.
So a lot of folks that were looking at premium financing from a client standpoint, as well as advisors or even my competitors that were selling premium financing, many of them were looking at premium financing as a way to borrow really cheap money and get a pretty massive spread or positive arbitrage, meaning that the cost of borrowing was so much less than the financial upside of the increasing value of the policy, that you should premium finance because the money was cheap. That's how it was being sold.
Yeah.
It should never have been sold that way. Even back when interest rates were that low, I was essentially the only one in our industry that was talking about what happens from a risk standpoint if the borrowing rates increase dramatically, and what would happen if at the same time, concurrently, the stock market was down. So the returns would be down, and all of a sudden we'd be in a pretty severe negative arbitrage situation. All my contemporaries in this industry were saying, "Oh, Darren, you're being overly dramatic. You're being too negative and pessimistic. That's never going to happen." It happened, and it's happening right now.
Absolutely.
Yeah, the reason why we've done well, I mean, last year was actually our best year in the business in 21 years of me being in the insurance industry. I believe is because we were so transparent up front. We were so educationally based up front that when these kind of two black swans hit at the same time, the clients were prepared for that, and the clients were educated properly at the point of sale of what these risks may be. The reason why these clients, though, I mean, no one's happy that interest rates are so high right now if you're using debt as a financial instrument, right? No one's happy about that. But if they entered the strategy with the understanding that the real strategy was to eke out a small positive arbitrage over time, and when I say over time, we're talking 15, 20, 30, 40 years. When you're looking long term, historically speaking, most indexes have outperformed the cost of capital, meaning that the borrowing rates over time have been less than what the index and those policies would have performed. So we've done some pretty extensive back testing and stress testing from the very beginning. And I think that's why last year, while a lot of other premium financing firms are suffering, and you have a lot of clients that are upset, and you have a lot of advisors that are freaking out because they have these really upset clients, the reason all that happened was that no one educated the client properly in the very beginning. And I'm going to this is speculation right here, what I'm about to say. I believe the reason is because many people in just sales in general, they conveniently omit the things that they're afraid are going to deter the client or the prospect from buying. That 100% goes against my code of honor and my code of ethics. The client should fully understand what they're doing, good, bad, and ugly. Sure, there are risks with premium financing. There's risks with any type of investment or financial instrument. But if the client really understands the core fundamentals of why this makes sense over time, short-term, bad times, they don't last. And when you have a client panicking and ready to pull out, it's usually because they weren't educated properly about what this really was and how this truly worked at inception.
Yeah. Now, I'm going to tee up what I think I'm hearing you say here about a client who might panic. And here's the kind of the synopsis that I get is that going into the premium financing strategy, rates are low. As those rates go up, then of course the cost associated with financing goes up. And so that's one component. But at the same time, the client is putting up some collateral, and that collateral may be in the form of the stock market. And the stock market could head south as well. And if those two pieces come together, then the client's going to have to be scrambling for more collateral or to have more cash flow go into this strategy. How did I do?
Yes, no, absolutely. The collateral piece, that's really the Achilles heel for most clients. I don't care how tough or risk tolerant the client espouses to be at the very beginning. Oh, I can handle risk. I'm a risk
Yeah.
taker. As soon as
Yeah.
they have to write the check or wire the funds, additional funds, that's when they're crying the blues, and then they start pointing fingers and accusing everyone within a 100-mile radius of them of leading them astray. Understanding that emotional side of human nature, in my estimation, is one of the things that we do a really good job of when we're talking to a client and proposing this as a solution. Is I want to make sure this is right for this particular client. It's not right for everyone. In fact, it's not right for most people. But for the right type of client, this is a match made in heaven. I mean, this is a tailor-made strategy for the right type of client. I'll give you an example. That last year, we had a client that had been in our strategy for 2 years. And last year, things went a little haywire, right? The borrowing rate that we got him into the deal just a few years ago was 1.35% all in. That is incredibly low. 2 years later, his renewing borrowing rate was pushing 7%. So going from 1.35% to almost 7%, that's a huge hike. The other problem is that the collateral account that he posted was heavily positioned in Amazon and Tesla stock. And it just so happened within that specific 12-month cycle that was in March, Amazon stock and Tesla stock tanked in value 30% during that 12-month segment. That means that the account he posted for collateral, or as collateral, decreased by about 30%. So he had to true that up. And he had to transfer or post other investment accounts as collateral to make up that shortfall. For that particular client, it was not a big deal. And the reason it was not a big deal is because from the very beginning, we looked at his liquidity and we talked about the risks. We talked about what could happen. And he was the right type of client to do this. He was extremely liquid. So for him to true up the collateral amount was not a big deal at all. I mean, it's a very, very small part of his overall liquid net worth. Conversely, I've heard of several clients that were financed by, I guess, my competitors, where the advisor comes to me crying the blues saying, hey, my client is getting ready to sue me. They're $1 million upside down. They don't have the collateral to post. What they were told from the very beginning was that the collateral requirement was going to be severely less than what it is today. What am I going to do? Can you help me? In certain scenarios, I was actually able to help that advisor kind of dig themselves out of the hole with the client. And in other cases, there was literally nothing that anyone could do. The client was going to be required to write a big fat check. And when I say big fat check, I'm talking about a 7-figure check to the bank to true up the shortfall. And as I was told, these clients did not have the ability to stroke a check for $1 million+. So this is why sometimes premium financing gets a bad rap, is that it was just abused by the wrong advisor, selling it to the wrong client, being advised by the wrong premium financing intermediary. And everyone was just looking at the payday, right? The commission payday, as opposed to the client's best interests. That's, I think, part of the premium finance life insurance industry. It can sometimes attract a greedy, overzealous advisor because the commission amounts on these policies, because they're so big, is pretty substantial. They could be multiple 6 figures and sometimes 7 figures in commissions. That amount that's paid out is not to the client's detriment at all. I mean, that's all built into the agreement between the advisors and the insurance carriers. So that's not like it's an overcharge to the client in any way, shape, or form. It's just that because the policies are so large, that commission amount scales up based on the size of the policy. So it's kind of the good news, bad news, right? It's like a double-edged sword. The good news from a business perspective is that it can be a very lucrative and very financially prudent way to structure a financial advisor's practice, because it can generate some pretty substantial revenue. The downside is that I've found that oftentimes that attracts the wrong type of advisors that are not advising whatsoever. They're just selling and closing and convincing clients to do this under possibly some false pretenses. And I don't mean to sound accusational, but I'm just telling you from personal experience, from what I've seen, a large majority of premium finance life insurance advisors are structuring this completely wrong for the wrong client.
Well, it sounds like what you're explaining is to sell this to someone is not the right approach. To be able to advise of the benefits of using premium financing, and at the same time explaining the good and the bad and what the risks are, is going to be ever important. But as important as that, I'm also hearing you say that first year review, that second year review, having a backup plan, understanding that nothing stays static and interest rates don't stay low, that in moving forward, you need to understand what you've bought, you understand the variables involved, and you have a backup plan. But as important as anything is to come back to the table a year later at anniversary and go over all aspects of the plan, the strategy, and why it continues to be important and valued by the client. And to me, that's kind of unique in this industry. In a lot of cases, I've heard people don't even come back and talk to them the next year.
That is an unfortunate part of this industry. And I would say really any industry where folks have the ability to earn a substantial income. When I say substantial, we're talking $500,000, $1 million and up, that type of compensation, or the ability to earn that type of compensation. Those types of industries I've found oftentimes attract money hungry people. Unfortunately, it's just the way it is. But yeah, if done properly and done ethically and done from an honorable standpoint, putting the client first, again, this can be one of the most valuable strategies they can implement as far as their overall estate planning and estate tax planning. My background, just kind of on a personal level, ethnically, I'm Japanese. I come from a descendants of samurai, and samurai lived by a very specific code of honor. That code of honor is called the Bushido Code. It's essentially 7 virtues that samurai lived by. One of those virtues is referred to as Makoto, which translation is honesty. But the concept of the English word honesty extends far beyond what you might look up in Webster's dictionary. To samurai, they said that samurai never used the phrase, I give you my word. They never used the term promise, because for samurai, to say and to do were one and the same. And that really, really got me enthused about my culture, because when someone says, well, I give you my word, or I promise you I'll do this, what it does is it negates everything that you said before that in your entire life, to where all those other things where I didn't give you my word, where I just said that I was going to do something for you, I didn't really mean it, right? I only mean it when I say I give you my word, or when you say I promise. It's like a differentiating between, well, here's where I'm kind of sort of committing to, but you should trust me and believe me anyway. And then, but here's what you really should trust me. To samurai, there was no distinction between the two. I actually wrote a book about this a couple of years ago called the Takeo Effect, where I talked a lot about these Japanese samurai principles and how they can be woven into standard business practice. But in premium financing, and really in any sort of financial services industry, this transparent, honorable way of serving your clients really should be at the highest level. And unfortunately, oftentimes it's not.
Yeah, the thing that I love listening to your process and the way that you explain to the clients, they fully understand what the risks are. But not only that, they also understand the background, the product, the background of the relationships of all parties involved, and with the emphasis of how this strategy may benefit them, as well as what the ups and the downs are, and those things like that. So really love that. How did you ever get involved in this particular line of work? What attracted you to premium financing specifically?
Sure. Yeah. 21 years ago, is when I got into the insurance industry. I started an employee benefits firm. We built that firm up to just shy of $40 million in annual recurring premium. We had 22 advisors. We were number 1 in the country with several insurance carriers concurrently. About a decade in, I started another agency, this time focusing on life insurance. It was a sister company housed out of the same office space that we were in. Built that up to our main hub was in Orange County, California. We had about a half a dozen offices spread in other cities and states, Manhattan, New York, Dallas, Texas, Las Vegas, Nevada, et cetera. And we got that up to just shy of 60 advisors. And we're doing a lot of life insurance business, primarily over the phone. This is before COVID, before Zoom, before anyone was doing this. Everyone said, you can't advise life insurance and sell life insurance to business owners over the phone, never having met them. This is a relationship-driven business. Well, kind of proved everyone wrong there. So things were going exceedingly well. And I was introduced to premium financing initially, actually, as a client. And I thought the strategy was very, very interesting. But my own client experience was so awful, meaning there were so many important details that were omitted up front, that as we got closer and closer, executing this transaction, all these unknowns were sprung on me at the last minute, and it really put a sour taste in my mouth. So I did a ton of research and looked at what all these premium financing intermediary firms were doing and how they were doing it. And I didn't like the process. I'm not saying these people were bad people, right? We just all have our preferences, and my preference is to be 100% transparent up front. I want to really understand the moving parts. A lot of people say in this industry, they advise life insurance agents and financial advisors to, KISS, keep it simple, stupid. Well, my response to that is there's nothing simple about premium finance life insurance, stupid. Okay, this is a very sophisticated, very involved strategy. And when someone is buying a 10, 20, 50, $100 million life insurance policy, I would think they would want to know how the moving parts work. I would think they would want to understand not only the probability of risk, but the consequence of risk, which is a big differentiation between those two. And so we really built our platform based on this educationally based, mathematically based strategy. So at the end of the day, I don't want the client to decide to move forward because of a personal relationship. I don't want them to move forward because it just sounds good. I don't want them to move forward not understanding everything, because if we are able to educate the client properly, where they fully understand what it is that they might be doing with this and why they would be doing it, if and when they decide to move forward, they know in their heart of hearts, this is one of the best decisions they ever made in terms of their overall estate plan. And again, it's about doing the right thing,
Yeah, absolutely. What a great overview on premium financing. Just top to bottom, lots of good information there. So we're going to bring you back next week then, Darren. And on our next episode, we'll get into some details and discuss some of your real world examples of how you use premium financing in financial plans, and really talk about two basic strategies here: the estate planning legacy that you were talking about earlier, and then maybe take a deeper dive into that tax-free retirement income. So we really look forward to taking that deep dive and getting into the next episode with you.
That sounds great. Look forward to it.
All right. Well, Darren and Ken, thank you for your insights into premium finance life insurance and the roles it can play. Now, listeners, we hope you have found this information valuable, and we remind you to follow this podcast for more proactive tax strategies in future episodes, including another episode with Darren. I'm Patrice Sikora. Thank you for being with us, and until next time.
Thank you for listening to the Proactive Tax Strategies podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.pinnaclefinancialwealthmanagement.com or give us a call at 321-454-3623. Investment advisory services offered through Arlete Wealth Management, AWA, an SEC-registered investment advisor. Pinnacle Financial Wealth Management, AWA, and AWM are independent entities. Discussions are meant to be general in nature and may not be suitable for all investors. Please consult a tax professional regarding any tax implications.